Good evening, everyone. Welcome to the first quarter results update of Hat National Bank. Let me straight away go into, I'll first of all take you all through the numbers for the first 10 minutes and then open it up for questions and answers. Right. Interest income for the first quarter 2018 recorded at 24.9 billion, up 10.5%. Interest expenses were up by 7.2. Overall NII grew by 10.7%. Fee income was up by 11.6. Net trading gains of first quarter 2007 turned into a net trading loss again due to movements in swap cost, which in turn gets reflected in the other operating income, gaining by 700 million. Net gains from financial investments were more or less the same. These are dividends that are received during the period. Impairment cost has gone up substantially during the quarter as a result of higher NPA, which I think the whole industry witnessed, which is a spillover from last year. Net operating income overall grew at 13.4% to 12.8 billion. Operating expenses were contained well at just 2% increase and recorded at 5 billion. VAT increased to 1.4 billion. PAT for the period was 6.3 billion, a 23% increase, and PAT of 4.5 billion, a 22.5% increase. At a group level, a similar trend. Again, 27 billion of interest income, growth of 10.7. NII grew by 13.4, fees by 11.6. Impairment, again, there was a growth as for in the bank to 1.3 billion. Expenses were more or less contained at just, actually the expenses overall saw a reduction at a group level. This also as part of claims from HMB Assurance coming down compared to the previous quarter last year. And overall PAT grew to 5 billion, which is a 24.3% growth. And profit attributable to shareholders, 4.6 billion, which was a 20.6% growth. So in terms of PAT, which we saw in the first quarter of 2017 at 3.7 billion, grew to 4.5 billion, main contributions coming from NII 1.4 billion, 200 million from fee income, other income of 500 million, and this increase in income was eaten up by high impairments and taxes mainly, and same with the group as well. So overall, for the quarter, loans grew by 5.3%. Overall, group assets went up by 37 billion. Loan book for the bank stood at 673 billion. Deposits grew by 2.7% to 721 billion. The NIMs continue to improve. NIMs for the bank stood at 4.9% and 5.4% for the group. This is an increase in NIM of 22 basis points for the bank from first quarter of 2017 and a 12 bips increase for the group. The important factor that we saw this quarter was a substantial growth in CASA, and the CASA ratio went up from 35.5% in December to 38%, and LKR CASA stood at 39%. Cost to income ratio continued to improve. At a bank level, cost to income ratio came down to 36.3%, and at a bank level it came down to 41.5% from 48.5% in first quarter 2017. As I mentioned earlier, NPAs continue to move up with the weather patterns that we had in the last 2 quarters. Though the weather has improved this year, that to monetize will take some time, and we have still seen some loans going into NPA, and also the slowdown in economic growth, the high interest rates have resulted in NPAs moving up, and we have seen industry NPAs also moving up to 3%. So overall NPA for the bank went up during this quarter. ROA for the bank went up to 1.84%, and for the group it went up to 1.96%. So again we have seen ROA and ROA especially continuously moving up, but ROE has got affected mainly as a result of the capital raising that we did in 2017. But as the leverage improves over the next couple of years, we expect ROEs to pick up substantially. So the capital adequacy ratios, you see that we are very comfortable in terms of capital adequacy ratios compared to the minimum capital adequacy requirement. Tier 1 we are about 400 basis points higher, and 300 basis points higher when it comes to total capital adequacy requirements. Closer look at ROE and ROA. Margins moving up had a positive impact on the ROA, so did other income to average assets. However, impairment to average assets gone up, which was a drag on ROA. Operating cost improved from 2.23% in 2017 to 2.06%. However, the taxation has also started moving up. So as a result, ROA, which stood at 1.66% in 2017 first quarter, has moved up to 1.84%, as I mentioned earlier, for the bank. It being leveraged at close to 9 times gives an ROE of 16.4%. For the group, the ROA, again, as I mentioned, went up to 1.96% compared to 1.75% in the first quarter of 2017, leveraged at 8.4 times, give us an ROE of 15.05% for the group. So this is again how the share has done over the last 12 months, as the stock market has also not done fairly well, with SPI dropping over the last 12 months. The stock has performed 4.8% during the year. The voting share, then the non-voting share, has seen a slight drop. Overall, the voting share is trading at below book value at 0.96, and non-voting is below 0.8 times, and PE is trading at just below 6.5 times for the voting share. So these are some of the awards that we have won: Best Retail Bank, Best SME Bank, so on and so forth, and Best Banker of the Year for 2017. Some of the recognition accolades that we have been continuously winning. So that's the presentation. Now I'll open it up for any questions. Well, there is a question on, can you tell us about the impact of IFRS 9? Have you computed the initial assessment? Yes, so we have computed the initial assessment. Initial assessment is that there might be around 4.5 billion impact on reserves as a prior year adjustment. So that's the current assessment that we have, which might have an impact on reserves, which is roughly about 0.4, 0.5 or 40 to 50 basis point impact on capital adequacy ratios. But since we have about 400 basis points additional capital than the minimum requirement, it's not going to have a significant impact. So the NPL, there's a question asking in which sectors did you see NPL hike? I guess it's there is no specific sector as such. Mainly, I think it's on agriculture, but in probably in other areas as well where there might be a spillover from the agriculture sector as well as impact due to the slowdown in the economy. So the loan growth expectation is that the loan growth for the full year would be somewhere in the range of 15%. And we would also expect our loan growth to be more or less in line with that. The growth we expect would come from SME, and when I say SME, it could be trading mainly, as well as on corporate. So it'll mainly be on working capital, and if it's a sector, I would say it mainly be trading. Okay, so there is a question on what's happening on private sector credit growth. Private sector credit growth has been coming down. So the private sector credit growth, which was over 20%, has now come down to around 15%, and the expectation is it may come down close to around 13% in the next few months. So we have also seen a slowdown in credit growth. Last year, for the full year, we did only a growth of 9%. Even in the first quarter, we have seen some slowdown continuing, and we think that would continue until interest rates come down and you see economic growth picking up. So that would be the expectation, and as I mentioned earlier, we don't expect the credit growth for the industry to be significantly more than 15% for the year. Well, I think, there is a question saying over the past 4 quarters, we have seen HMB's disbursements to be very low compared to Combi and Sampath in absolute terms. Their NIM drops are also similar that experienced by HMB. I don't think we experienced a drop in NIMs. To the contrary, our NIMs actually improved, as I showed earlier. So our strategy has been, as I think we mentioned earlier in one of the earlier WebEx calls, that we would not grow our portfolio if it does not contribute to the P&L. So if there is a portfolio which brings yields at AWPLR and we have to pay more than AWPLR to mobilize marginal deposits, then we'll probably scale down on the portfolio and not pay substantially high on the deposits. So that has been the strategy even last year, where we saw AWPLR not moving, being stagnant around 11%, but deposit rates going to 11, 12, even 12.5, which did not make much sense in terms of taking those deposits and still maintaining short-term loans at around 11%. So therefore, last year we took a conscious decision of letting go some of those loans and thereby not having to be too aggressive on the deposits, fixed deposit side. This year, things have changed a bit. We have seen fixed deposit rates coming down from the 12% down to 10.5%, 10% levels. AWPLR still remains around 11, 11.5. So there are opportunities of leveraging on that, and then we will continue to leverage. So the principle is that PNL, we will drive PNL, and we will not drive balance sheet at the expense of the PNL. So I think I touched on the NPLs moving up, mainly a spillover effect from last quarter, the agriculture sector contributing fairly substantially to that. Improvement in CASA ratio, is this a temporary one? I wouldn't say it's temporary. I think it's all the initiatives we have taken in capturing the payment and cash flows of corporates, SMEs, as well as individuals have paid off. in terms of improving our CASA ratio, and we think we should continue to improve the CASA ratio to over 40%, especially if the fixed deposit rates start coming down. We will see that there will be more conversion of FDs into CASA, and we feel that that would also drive the CASA ratio. So I think there's a question again, are you seeing a pickup in the economic activities in towns dependent on agriculture? Still it's a bit too early, because I think you still need to go into harvest, and the money needs to come in. So I think there is still some pressure in some of the rural economies, but I believe it would improve eventually. What is the impact of SLFRS 9 on income statements of the year? That's a bit tougher question than I think the prior year adjustment I mentioned earlier. It's going to be around 4.5 billion. Impact on P&L will depend on the portfolio, how the portfolio moves, how we will be able to bring down the NPAs, bring down the overdue loans. So we still believe that around 30 bips credit cost is something that we would like to work around. So that's what we will be aiming at and trying to work within. So HMB Assurance has been doing well. They have there's a question on HMB Assurance. They have also, I believe, got a one-off gain coming through through the revaluation of the life portfolio in the quarter. So overall, I believe the business is moving in the right direction. Their premiums have been improving. They had some problems in their general insurance claims over the last few years, but I think they have got their underwriting strategy right now, and they've been able to bring down the claims ratio, and both companies are fairly profitable. Last year, actually, they did a ROE of 28%. Is there any update on debt repayment levy? No, not yet. So I don't think I have any additional information to give you in terms of the debt repayment. What are your thoughts on deposit and lending rates for 2018 and 19? Well, my expectation on lending and deposit rates, at least for the next 6 months, is that it would likely come down as a result of slowdown in credit growth. Inflation is still around 5%, though it might go up slightly with the increase in oil prices. It will be more headline inflation going up and not core inflation. So I think there is room for lending rates to come down, and lending rates will have to come down for the economy also to start improving. The central bank has also given a direction towards lending rates coming down by reducing the policy rates by 25 basis points a month back. So the expectation is that the lending and deposit rates come down, though treasury bill bond rates might would not probably go down as much because of the pressure in US LIBOR rates moving up. I would expect more convergence between the deposit and lending rates towards the risk-free rate. Overall loan growth expectation in the medium term, as I mentioned, this year it will be low, but I expect it will start picking up again in 2019. For the loan growth to go beyond 20%, I think the economic growth will have also need to move over the 5% mark. So I would expect that probably to happen by around 2020. So there is a question on what do I think would be the direction of the NIMs and interest rates. I think I answered the question on interest rates. NIMs I would think would be more or less flat. Normally when interest rates come down, the NIMs tend to compress for banks because of the high CASA ratios, CASA rates not moving, and loans getting repriced. But this year, since for the first 3 months the NIMs have improved, and the likelihood is that that would continue in the current quarter as well, even though rates fall in the last half. There would not be much pressure on NIMs this year, so I would expect NIMs to more or less be flat from 2017. Well, the question is there underbanked potential? Well, I think there is, not like some of the economies where you have significantly underbanked areas, but I think there is still potential for the banking sector to penetrate. I think this penetration might happen more through technology, more through mobile, than rather through a brick and mortar expansion. So there's a question on cash management solutions and how that has benefited CRASA growth. So that's what I alluded to a little while ago for the question where there was a question saying whether the CASA growth was temporary. I don't think so. I think the CASA growth is coming mainly from these initiatives that we have taken in driving cash management and solutions. So the corporate banking CASA growth has been fairly substantial as well, which means that there is a lot of CASA growth coming through our cash management systems. So there's a question on expenses growth. It's managed well, as we have been mentioning over the past. The BPR initiatives that we have taken, centralization of various activities. We centralized credit underwriting few years back. Last year we centralized recoveries function. Now we are centralizing documentation and disbursement function. So all these will continue to have impact on cost, and we have seen that happen in over the last years, and will continue to leverage on that over the couple of years as well. So we are quite bullish in terms of bringing the cost to income ratio down below 35% over the next year and a half. So there's a question on Grameen. What's the loan book of Grameen? Grameen would have a loan book of around roughly 18 billion rupees. Their NIMs are pretty high, of course, being a microfinance institution. I think it would be close to around 15%. NPAs of Grameen would be around 5%. So that I think NPAs would be around 4% for Grameen, and the NIMs would be around 15. So there's a question I probably don't. I think it's asking with cost control and commission growth offsetting cost of risk. Sustainable ROE could be easily 16. I think we are already achieving a sustainable ROE of 16% at a group level. It's just that the leverage is low. We would want to target a sustainable ROE of 20%, and we will not be happy with a 16% sustainable ROE, and that's what we are working towards. Dividend policy in light of strong capital buffers, even taking into account the 40-50, I think you had mentioned. So the dividend payout, the board approved dividend payout is around 25 to 35%. But until we are comfortable in seeing the IFRS, how IFRS impact turns out, and then the new, until the Basel III regulations kind of until we see that Basel III regulations in full force, we might stick to the lower end of the 25 and the 35 than the upper end. So the payout ratio over the next 1 or 2 years will be more closer to the 25% than the 35%. So the biggest challenge for 2018 would be the bringing down the NPA levels that have gone to 2.7%. So our target is to bring it below 2% and get to where we were by in 2016. So there'll be a lot of effort towards bringing the NPA levels down. So what is the number of branches planned for this year? So in 2010, I think we had 150 branches. By 2012, we ramped that up to 250 branches. From 2012 up to date, we have maintained our branch level at 250. So even in the next 3 years, I wouldn't see a significant increase in the branch numbers from 250, and the channel strategy will continue to be driving digital channels rather than brick and mortar. So there's a question, is there a change in the IT platform in HNB? Our core banking remains Finacle, so that has not changed. I think we rolled out Finacle in 2017, so for the last 10 years we have been using Finacle, and we are very happy with the solution we have. So no, there is no change in the platform. There's a question on what will be the impact of IFRS 9 to the NPA level. So NPA level is a central bank calculation on the number of days overdue, and that will not be determined by IFRS 9. IFRS 9 will be more on impaired asset and not on NPAs as such. There is a question on why is the minority interest number so high in first quarter. So the minority interest come through Grameen. We only own 42% of economic rights of Grameen, so there is a 50% there. Then there is 40%, we only own 60% of HMB Assurance, there's 40%, and then there's of course our investment bank where Lanka Ventures, part of the Lanka Ventures income goes as minority interest. So that's where the minority interest come through. So any specific area where it increased from 2000 and, well, I believe in 2017 first quarter HNB Grameen numbers got affected because of the provision we had to make for interest. So that's probably why 2017 numbers, first quarter numbers were low, and that probably was not there in first quarter 2018. So a question on FreeMe, do you see it as a challenge? Well, no, I think various banks have their digital initiatives. We have our own digital initiatives. We have our own plans on payment apps, and we have been launching few as well. And so I think it's not just FreeMe. Every bank will come up with similar apps. So I don't think it's just one of many digital initiatives that most banks will be doing and have been doing in the past. That's all the questions I have up to now. Any more questions? So if there are no other questions, thank you very much for joining today, and we hope to meet you all again with our second quarter results. Thank you very much.